Let me ask you something important. If your entire trading income depends on one single strategy, what happens the day that strategy underperforms? Most traders think like gamblers: one system, one edge, one hope. Professionals think like portfolio managers. In this episode, you will learn how to build a structured, multi layered trading architecture that survives market evolution. Hi everyone, welcome back to Wednesday Moves. This is episode 28 of our professional trading course. In the previous episode, we discussed adapting to market regimes. Today, we take that idea further and explore how professionals structure their capital across multiple strategies instead of depending on a single source of performance. Because long term sustainability requires structure, not luck. From trader to portfolio manager, there is a mental shift that happens when a trader becomes professional. You stop thinking in terms of individual trades and begin thinking in terms of capital allocation. Instead of asking, is this trade good? You begin asking, how does this trade fit inside my overall capital structure? This shift alone transforms consistency. Why one strategy is not enough? Even the strongest trading edge goes through cycles of underperformance. If all of your capital is tied to one approach, your emotional stability becomes fragile during drawdowns. Diversification across uncorrelated strategies reduces dependency on a single outcome stream. Core versus satellite model. Professionals often use a core strategy that generates consistent baseline returns. Around that core, they build smaller satellite strategies designed to perform in alternative conditions. And this layered approach smooths equity curves and reduces volatility. Strategy correlation awareness. Not all strategies are truly different. Two strategies on different time frames may still depend on the same market behavior. Correlation analysis prevents hidden duplication of risk. Balancing time horizons. A professional portfolio may include intraday trades, swing trades, and longer term position trades. This diversification of time This diversification of time exposure reduces dependence on one specific session or volatility cycle. Risk distribution framework. Risk should not only be controlled per trade but also per strategy and per portfolio. Total exposure must remain within defined limits to prevent systematic risk. Performance based allocation. Capital allocation should evolve based on statistical performance. Strategies demonstrating consistent expectancy may receive increased allocation, while underperforming strategies are scaled down methodically. Capital segmentation. Professionals separate capital into categories: core capital for stable returns, experimental capital for innovation, and reserve capital for protection. This structure ensures resilience. Psychological benefits of uh, the structure. Like when capital is structured intelligently, emotional volatility decreases. Losses in one strategy are balanced by stability in another, creating smoother psychological experience. Measuring portfolio efficiency. Professionals evaluate not just profit but risk adjusted return, drawdown depth, and consistency metrics. The goal is not maximum growth, it is sustainable growth. When to retire a strategy. Every strategy has a lifespan. If structural shifts invalidate its age statistically, retirement may be necessary. Discipline means letting go when data confirms decay. Building long term wealth architecture. Wealth is not built through isolated trades, it is built through structured compounding across diversified ages. Patience and architecture outperform aggression and impulse. Here's a key message: a trader manages trades, a professional manages capital structures. Structure creates sustainability. In the next episode, we will move into a high level performance optimization and equity curve engineering, a topic rarely discussed openly. If you're serious about mastering trading at a professional level, subscribe and continue this journey with me. See you in the episode 29 of Wednesday Moves.